higher long-term yields, surging energy prices, and powerful earnings are pulling asset prices in very different directions today. You are watching vTalkInsight, Allocator's Lens Daily for August 3rd, 2026. Let's start with equities, where that tension is most visible. In equities, the big picture is a market that still looks fundamentally strong, even as financial conditions tighten around it. The S&P 500 is holding near record levels with gains broadly distributed. European benchmarks like the Euro stocks are grinding higher, and Korean stocks have staged a sharp rebound. Yet this resilience is set against the backdrop of higher long-term yields and an energy shock. Earnings are doing a lot of heavy lifting for this tape. Profit growth for the S&P 500 this quarter is running close to 47% year-on-year, marking a fourth consecutive season of clearing high bars, which has even allowed for some multiple compression despite elevated valuations. In Europe, banks are a key support. Crédit Agricole and NatWest both beat expectations, with strong revenues, better than anticipated cost of risk, and upgrades to medium-term return targets. Technology remains at the center of the story, but in a more selective way than earlier in the AI cycle. Amazon's cloud arm just delivered about 37% revenue growth, its fastest expansion in years, with margins above expectations and management pointing to capacity that will need to double by the end of 2027, yet still remain constrained by demand. What stands out is how equity markets are rewarding companies that can clearly link heavy AI and digital infrastructure spending to tangible earnings. For Amazon, strong cloud revenues, accelerating e-commerce and advertising, and visible returns on data center capex have driven a double-digit share price jump, while firms with equally solid numbers but weaker communication are being punished, creating unusually wide dispersion beneath the index level. Beneath the calm of a relatively low volatility index, the underlying tape has turned far more two-way. Small caps are lagging under the weight of higher borrowing costs. Volatility strategies and hedges have outperformed as risk aversion builds, and a recent collapse of a heavily leveraged AI-focused hedge fund showed how quickly concentrated trades can unwind, with assets plunging from roughly $45 billion to about $10 billion as margin calls force liquidations. The AI theme itself now carries both upside and headline risk. On one hand, medium and long-term demand for AI chips and cloud infrastructure still looks robust, supporting Korean chipmakers and U.S. platforms. On the other, high-profile AI security lapses and calls for tighter oversight increase the chance of regulatory or cyber shocks interrupting the trade. For allocators, the key equity questions are whether leadership continues to broaden beyond megacap tech, and how far higher yields and energy costs can rise before they start to erode this earnings cushion. Turning to rates, the defining feature is a powerful bear steepening of the U.S. curve. Long-term Treasury yields are at their highest levels in nearly 2 decades, with the long end rising for 5 straight weeks as markets price a higher for longer regime and demand more compensation for inflation and fiscal risk. Several forces are pushing those yields higher. Inflation is proving sticky, with the latest employment cost data pointing to persistent wage pressures, while supply-side shocks in labor, energy, and trade are compounding rather than fading. At the same time, very large Treasury issuance, reduced central bank balance sheet support, and doubts about the Federal Reserve's resolve are all contributing to a higher term premium. The policy backdrop is complicated by rising internal dissent at the Fed. Some officials are arguing for a series of incremental rate hikes now, warning that relying on higher long-term yields or balance sheet shrinkage alone will not restore price stability, and that postponing action risks a much more aggressive move later, potentially including a larger 50 basis point increase as soon as September. Markets are also grappling with a communication challenge. Reduced forward guidance was meant to give the Fed flexibility, but recent ambiguous messaging has made it harder for participants to infer the reaction function, leading many to view the central bank as overpromising and underdelivering on inflation control. That perceived credibility gap is itself adding upward pressure on yields and raising volatility along the curve. Higher long-term yields are already tightening financial conditions in the real economy. Mortgage rates and other long-duration borrowing costs are rising. Rate-sensitive investments are under strain, and negative wealth effects are expected to slow consumption over time. For multi-asset portfolios, The key is how far this adjustment runs before it undercuts the growth and earnings strength that have so far kept risk assets resilient. Credit markets sit right at the intersection of solid fundamentals and more expensive capital. Wider spreads are emerging where large, long-dated funding is needed, especially around data centers and digital infrastructure, even as corporate balance sheets and cash flows remain generally healthy. Private credit continues to attract substantial institutional demand. One major manager reported a record quarter with over $36 billion of inflows, loan non-accruals below 2%, and around 10% cash flow growth across its direct lending portfolios, helped by productivity and margin gains from AI and digital tools. Yet not all of the picture is benign. Hyperscaler and data center capex is so large that it is straining financing capacity, pushing spreads wider and slowing the pace at which new projects can be brought online, while the recent forced deleveraging of a concentrated AI hedge fund highlighted how quickly liquidity can vanish when collateral values fall sharply. On the traditional side, bank earnings and consumer credit data look better than many feared. European banks have posted strong results. Card loan performance at major issuers is holding up, and corporate portfolio companies report slower but still positive cash flow growth with stronger margins and lower leverage. For allocators, the main watch points are whether long-term yield pressure drives a more broad-based spread repricing and how private and public credit share the burden of funding the ongoing AI and infrastructure build-out. In foreign exchange, policy divergence and capital flows are reshaping traditional correlations. Recent resilience in the U.S. dollar is increasingly tied to strong foreign inflows into U.S. equities rather than treasuries, shifting the currency's sensitivity toward equity risk and underscoring how closely global capital is tracking the U.S. growth and earnings story. The yen is a second major axis for FX risk. Japan has already spent tens of billions of dollars in a single day to support the currency, and persistent yen weakness has become a domestic political issue. Yet the Bank of Japan has so far moved only cautiously on rates despite signaling upside inflation risks. Markets now see the medium-term dollar path as hinging more on Asian currencies and potential Japanese investor repatriation than on moves in the euro or sterling, making upcoming BOJ decisions and yen volatility key variables for cross-asset positioning. Commodities, and energy in particular, are amplifying the inflation narrative running through other assets. Oil prices have jumped about 20% over the past month, with Brent trading in the high 80s to above $90 as renewed tensions around the Strait of Hormuz and attacks on Black Sea shipping threaten key supply routes, while refineries in the U.S. and Europe run at or above full capacity. These pressures are creating notable distortions. Pump prices are increasingly driven by refined product bottlenecks rather than crude benchmarks, and industry voices expect elevated prices to persist until major disruptions are resolved and inventories rebuilt, even as softer Chinese demand helps cap the upside. At the same time, new European methane regulations due in 2027 and heightened shipping insurance risks add to the longer-term supply overhang, while strong results from companies like Chevron and large refiners suggest surprisingly resilient demand and reinforce oil's role in keeping inflation and term premia elevated. Pulling this together, the cross-asset picture is one where structural inflation forces and energy shocks are driving long-term yields higher, even as earnings strength and broadening equity leadership keep risk assets supported. Credit sits between those poles, with private credit and strong banks absorbing financing needs while spreads creep wider. Currencies are increasingly anchored in policy divergence and the link between the dollar and U.S. equities. And commodities, especially oil, are the main transmission channel from geopolitics into inflation and term premia. Allocators may want to watch how far bond markets push yields before growth and earnings crack, whether equity leadership can stay diversified without excessive leverage or AI crowding, and how yen policy and Middle East risks evolve from here. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.